Stop scrolling right now because what I'm about to tell you could save you from losing every penny you invest in penny stocks. Here's a shocking statistic that the financial media doesn't want you to know. Over 90% of penny stock investors lose money within their first year of trading these stocks, and most of them lose everything. I'm not talking about losing 10 or 20%. I'm talking about complete account wipes where people see their life savings disappear in days or even hours. Just last month, I heard about an investor who put $15,000 into a penny stock that had an impressive sounding AI technology and partnerships with major companies. The stock was trading at 30 cents, and he was convinced it would hit $5 based on the promotional materials he read. Within 2 weeks, the company announced a massive share dilution, the stock crashed to 3 cents, and his $15,000 became worth less than $2,000. The devastating part is that every single warning sign was there if he had known what to look for. This isn't 2020 anymore, this is 2026, and the penny stock landscape has become even more dangerous with new SEC regulations that ironically made some protections weaker, plus AI driven pump and dump schemes that are more sophisticated than ever before. The scammers have gotten smarter, the promotional tactics have become more convincing, and social media has made it easier than ever to manipulate inexperienced investors. But here's the good news. There's a survival checklist that can protect you from 90% of these disasters, and I'm going to share every single checkpoint with you in this video. If you're serious about penny stock investing and you want to separate the legitimate opportunities from the garbage and scams, you need to watch every second of this video because this checklist could literally be the difference between building wealth and losing everything you've worked for. Welcome back to the channel, and if you're new here, my name is your host, and this channel is all about helping everyday investors navigate the stock market with honest, no-nonsense analysis that protects your money first and chases profit second. Today we're diving into something critically important: the Penny Stock Survival Checklist for 2026 edition. Now, let me be clear about something right from the start. Penny stocks can absolutely create life-changing wealth. There are real companies trading under $5 that go on to become 10 baggers or even 100 baggers. Those stories are real, and they do happen. But here's what nobody tells you. For every legitimate penny stock success story, there are literally hundreds of complete disasters that wipe out investors. The problem is that most people don't know how to tell the difference between a legitimate opportunity and a disaster waiting to happen. They see an exciting story. They see other people talking about it on social media. They see a low share price and think they can buy millions of shares, and they jump in without doing any real research. That's financial suicide in the penny stock world. What I'm going to give you today is a step-by-step survival checklist that I personally use before even considering any penny stock investment. This checklist covers 8 critical checkpoints that professional analysts use to separate real opportunities from pump and dump schemes and failing companies. The beautiful thing about this checklist is that it takes only 15 to 20 minutes to run through for any stock, but it can save you thousands or even tens of thousands of dollars by keeping you out of disasters. We're going to walk through each checkpoint in detail. I'm going to show you exactly what to look for, where to find the information, and what the red flags are that should make you run away immediately. Now, before we dive into checkpoint 1, I need you to do something important for me. Hit that subscribe button right now and turn on the notification bell because I release stock analysis videos every single week where I break down real companies, show you how to do proper research, and help you avoid the landmines that destroy most retail investors. My goal is to give you the tools and knowledge that typically only professional investors have access to, but explained in plain English that anyone can understand and actually use. Also, I encourage you to have a pen and paper ready or open a note on your phone because you're going to want to write down these 8 checkpoints so you can use them every single time you evaluate a penny stock. This checklist should become your automatic process that you never skip, no matter how exciting a stock sounds or how many people are talking about it. All right, let's jump into checkpoint 1 and start building your survival checklist that will protect your hard-earned money in the dangerous world of penny stocks. Checkpoint 1 is the financial health check, and this is where you need to start every single time before you even think about anything else. Here's what you're looking for. You need to pull up the company's basic financials, which you can find for free on platforms like Yahoo Finance, MarketWatch, or directly from SEC Edgar filings. The first thing you're checking is revenue growth over the last 3 years. Does this company actually have revenue that's growing, or are they just burning cash with no income? A legitimate company should show consistent revenue growth or at least stable revenue. If you see revenue bouncing all over the place, or worse, declining year after year, that's a major warning sign. Next, you need to look at profit margins. Now, I'm not expecting penny stocks to be hugely profitable, but you want to see either positive profit margins or at least improving margins that show they're moving toward profitability. If a company has been operating for 5 or 10 years and margins are getting worse instead of better, that tells you they have fundamental business problems they can't solve. The third critical metric in this checkpoint is the debt to equity ratio. For penny stocks, you want to see this ratio below 0.5, meaning their debt is less than half of their equity value. Penny stocks with massive debt loads are disasters waiting to happen because they're constantly at risk of bankruptcy or being forced into terrible financing deals that destroy shareholder value. Here's the biggest red flag at this checkpoint. If you find a company that has zero revenue or only expenses with no income, you need to understand that you're not investing in a business. You're gambling on a story or a promise. Sometimes that's acceptable if you know what you're doing and you're investing in very early stage biotech or technology with a clear path to revenue. But for most investors, companies with no revenue are just too risky. This financial health check should take you about 3 to 4 minutes. And if a company fails this checkpoint badly, you can save yourself time and just move on to the next opportunity. Checkpoint 2 is cash burn rate analysis. And this is absolutely critical for penny stocks because running out of cash is how most of these companies die. Here's what you need to do. Go to the company's most recent quarterly report and look at the operating cash flow section. Operating cash flow tells you how much cash the company is using or generating from its actual business operations. For most penny stocks, this number is negative, meaning they're burning cash every month. What you need to calculate is the monthly burn rate, which you can estimate by taking the quarterly operating cash flow and dividing by 3. So if they burned $6 million in operating cash flow last quarter, that's roughly $2 million per month. Now here comes the critical calculation that most investors never do. Take their current cash balance, which is listed on the balance sheet as cash and cash equivalents, and divide it by the monthly burn rate. This gives you the runway, which is how many months the company can survive before they run out of money. If a company has $12 million in cash and burns $2 million per month, they have a 6-month runway. Here's my rule. If a penny stock has less than 6 months of runway, it's extremely high risk because you know with certainty that they'll need to raise money very soon. And here's why that matters. When penny stocks raise money, they almost always do it by issuing new shares, which dilutes existing shareholders. If you own 1% of a company and they issue 50% more shares to raise cash, you now own 0.67%, and your investment just lost value even if the share price stays the same. Companies with short runways are constantly diluting shareholders, and that's a wealth destroyer. Look for companies with at least 12 months of runway, or better yet, companies that are cash flow positive and don't need to raise money at all. This checkpoint takes about 3 to 4 minutes and can save you from investing in a company that's about to massively dilute you. Checkpoint 3 is share structure investigation, and this is where you uncover a lot of the manipulation and problems that plague penny stocks. You need to check several numbers here: total outstanding shares, authorized shares, float size, and recent corporate actions. Outstanding shares is how many shares currently exist. And for penny stocks, if you see numbers over 1 billion shares, that's generally a warning sign of a company that has diluted heavily. Authorized shares tells you how many shares the company is allowed to issue. And if authorized shares are way higher than outstanding shares, that means they have room to issue a lot more shares and dilute you. The float is the number of shares available for public trading, and you want to pay attention to the ratio of float to outstanding shares. A very low float compared to outstanding shares can mean insiders hold most of the stock, which can be good or bad. If it's a legitimate company with confident insiders, that's good. If it's a shell company where promoters hold most shares, that's bad. You also need to check the trading volume relative to float. If the float is 10 million shares and daily volume is consistently 1 million shares, that's 10% of the float trading daily, which often indicates a manipulation or a pump scheme. Another critical thing to check in share structure is recent reverse splits. A reverse split is when a company consolidates shares, like turning 10 old shares into one new share. Companies do this when their share price has fallen so low they risk being delisted. Reverse splits are almost always a red flag because they indicate a company in serious trouble, and statistically, most stocks continue falling after reverse splits. If you see a company has done multiple reverse splits, run away immediately. That's a serial diluter that destroys shareholder value repeatedly. You can find all this share structure information on the company's investor relations page, on your broker's platform, or on free sites like OTC Markets if it's an OTC stock. This checkpoint takes about 3 to 4 minutes and reveals a lot about how the company treats shareholders. Checkpoint 4 is management background verification, and this is something most retail investors completely skip. But it's absolutely essential for penny stocks. You need to research who is running this company because penny stocks often have questionable management teams with histories of failure or even fraud. Start with LinkedIn and look up the CEO and key executives. What's their background? Do they have actual experience in the industry this company operates in, or did they just jump into this role from something completely unrelated? A biotech company run by someone with no science or pharmaceutical background is a red flag. A technology company run by someone whose last job was in real estate should make you suspicious. You want to see relevant experience, and a track record of success, not someone learning on the job with your money. Next, you need to search their names along with keywords like SEC violation, fraud, lawsuit, or bankruptcy. You'd be shocked how many penny stock CEOs have been involved in previous failed companies or even regulatory actions. If you find that the CEO was involved in another penny stock that collapsed or was sanctioned by regulators, that's a major red flag. These serial entrepreneurs in the penny stock world often jump from company to company, raising money and enriching themselves while shareholders lose everything. Another critical thing to check is insider ownership. Go to the SEC filings, specifically the DEF 14A proxy statement or Form 4 filings, and see how much stock the CEO and management team actually own. If they own a significant percentage, like 10 to 30% of the company, that's generally a good sign because their interests are aligned with shareholders. But if insiders own almost nothing, or worse, if you see them constantly selling their shares, that tells you they don't believe in the company's future. Why would you invest your money in a company that the CEO won't invest in or is actively selling? One more thing to check: management compensation. Look at how much they're paying themselves in salary and stock options. Penny stocks with no revenue shouldn't be paying executives six-figure salaries and granting themselves millions of stock options. That's a sign they're enriching themselves while the company burns shareholder money. This checkpoint takes about 4 to 5 minutes, but can save you from investing in a company run by incompetent or dishonest people. Checkpoint 5 is the business model clarity test, and this is where you separate real companies from smoke and mirrors. Here's what you need to do. Read the company's description on their website and in their SEC filings, and ask yourself one simple question: do I clearly understand how this company makes money? A legitimate business should be able to explain their business model in a few simple sentences. We make this product, we sell it to these customers, they pay us this much, and this is our profit. If you're reading paragraph after paragraph of complex technical jargon, buzzwords, and vague descriptions about disrupting industries and revolutionary technology, but you still can't figure out exactly how they make money, that's a massive red flag. Scam companies and failing companies hide behind complexity because they don't want you to understand that there's no real business there. Another thing to check: do they have actual customers and real contracts, or just potential partnerships and letters of intent? A letter of intent means basically nothing. It's not a binding contract, it's just a statement that two companies might work together in the future. I've seen dozens of penny stocks announce letters of intent with major companies, the stock pumps on the news, and then nothing ever comes of it. You want to see actual signed contracts with real revenue numbers attached. Also, be extremely suspicious of companies that constantly pivot their business model to whatever industry is hot at the moment. A few years ago, every struggling penny stock suddenly became a blockchain or cryptocurrency company. Then they all became cannabis companies. Then it was electric vehicles. Now it's artificial intelligence. If you see a company that started as a mining company, became a tech company, then a cannabis company, and now they're an AI company, you're looking at a shell that's just chasing trends to raise money from investors. Legitimate companies have a clear focus and strategy that doesn't change every 6 months based on what's trendy. This checkpoint takes about 3 minutes and helps you avoid investing in companies that are all story and no substance. Checkpoint 6 is volume and liquidity check. And this is critically important because even if you find a great penny stock, if you can't sell it when you want to, you're in trouble. Here's what you need to check. Look at the average daily trading volume over the past 3 months, not just one day. You want to see consistent volume, not occasional spikes. The question you're asking is, can I sell my entire position in one day without significantly moving the price? Let's say you're planning to invest $5,000 in a penny stock trading at 50 cents. That's 10,000 shares. Now look at the average daily volume. If the average daily volume is only 20,000 shares, you'd be trying to sell half the daily volume, which means you'd probably have to accept much lower prices to find buyers. That's in a liquid stock, and it's dangerous. A good rule of thumb is that your position size should be no more than 5% of average daily volume if you want to maintain liquidity. Another thing to watch for is artificial volume spikes that indicate pump and dump schemes. If a stock normally trades 50,000 shares per day, and suddenly it's trading 5 million shares with the price shooting up while promotional articles flood the internet, you're watching a coordinated pump scheme. The promoters and insiders will sell into that volume spike and the stock will crash back down. Don't be the person buying at the top of a pump. You also need to check the bid-ask spread, which is the difference between the highest price a buyer will pay and the lowest price the seller will accept. For liquid stocks, this spread is tiny, like a penny or less. But for illiquid penny stocks, the spread can be huge. I've seen penny stocks where the bid is 30 cents and the ask is 40 cents. That's a 25% spread, which means you lose 25% the moment you buy just from the spread alone. Avoid stocks with wide bid-ask spreads because those transaction costs will eat your profits, even if you pick the right stock. This checkpoint takes about 2 to 3 minutes and ensures you can actually exit your position when you need to. Checkpoint 7 is promotional activity screening, and this is your defense against pump and dump schemes that destroy so many penny stock investors. You need to actively look for signs that a stock is being artificially promoted. Start by searching the company name plus words like stock promotion, paid promotion, or newsletter. If you find articles or newsletters promoting the stock, scroll all the way to the bottom and look for disclaimers. By law, paid promotions have to disclose that they were compensated, and these disclaimers will tell you who paid them and how much. I've seen disclaimers that say things like, "We were paid $50,000 in cash and 100,000 shares to promote this stock." That immediately tells you this isn't organic interest, it's a paid pump. Next, look at social media activity around the stock. Are you seeing dozens of brand new accounts or accounts with no history suddenly posting about this stock constantly? Are you seeing the same promotional language copied and pasted across multiple platforms? These are signs of coordinated promotional campaigns. You can also do reverse image searches on promotional materials. Sometimes the same promoters use the same graphics or website templates across multiple pump schemes. Check domain registration information for promotional websites using tools like HoHoIS lookup. If a website that looks professional was just registered 2 weeks ago, that's suspicious. Also, be wary of companies that issue press releases constantly about minor developments. Legitimate companies announce meaningful news. Scam companies issue press releases every week about things like management conference calls or exploring strategic opportunities, just to keep their name in the news and maintain promotion. Another red flag is when you see unusual options activity or insider selling during promotional periods. If the company and insiders are promoting heavily while also selling their own shares, they're dumping on retail investors. This checkpoint takes about 4 to 5 minutes and can save you from being the victim of an organized pump and dump scheme. Checkpoint 8 is catalyst and timeline validation, and this is about making sure you're investing based on real upcoming events, not vague promises. A catalyst is a specific event that could move the stock price, like an FDA approval decision, an earnings announcement, a product launch, or a major contract award. The key word is specific. You need a clear catalyst with a definite timeline. Be very suspicious of companies that talk about upcoming news or anticipated announcements without any specific dates or details. I've watched penny stocks announce that they have major news coming in the near term for months or even years, and the news never comes. That's a tactic to keep investors holding while insiders sell. When you identify a catalyst, you need to verify it through independent sources, not just company press releases. If a company says they're awaiting FDA approval, go to the FDA website and verify that there's actually an application pending. If they say they have a contract with a major corporation, search that corporation's press releases and SEC filings to confirm it. You'd be surprised how many penny stock announcements are exaggerated or completely made up. Also, check the company's history of meeting timelines and delivering on promises. Go back through their old press releases and see if they actually did what they said they would do when they said they would do it. If you find a pattern where they constantly announce catalysts that never materialize or get delayed indefinitely, that tells you management either can't execute or is deliberately misleading investors. A legitimate catalyst should be verifiable, specific, and ideally not entirely dependent on the company's own actions. An FDA decision date is good because it's external. A company saying they'll launch a product in Q2 is less reliable because they control that timeline and can change it. This final checkpoint takes about 3 to 4 minutes and ensures you're investing based on reality, not hype and empty promises. So there you have it, the complete penny stock survival checklist for 2026 with all 8 critical checkpoints that can save you from disaster. Let me summarize what we covered. Financial health check to make sure the company has real revenue and manageable debt. Cash burn rate analysis to ensure they won't run out of money and dilute you. Share structure investigation to spot serial diluters and manipulation. Management background verification to avoid incompetent or fraudulent leadership. Business model clarity test to separate real businesses from smoke and mirrors. Volume and liquidity check to make sure you can actually sell when you want to. Promotional activity screening to avoid pump and dump schemes, and catalyst validation to invest based on real events, not empty promises. Here's what I want you to understand. Running through this complete checklist takes only 15 to 20 minutes per stock, but it will protect you from 90% of the penny stock disasters that wipe out retail investors. The discipline to use this checklist every single time, without exception, is what separates successful penny stock investors from the casualties. If a stock fails even 2 or 3 of these checkpoints, you should walk away no matter how exciting the story sounds or how many people on social media are talking about it. Your job as an investor is to protect your capital first and chase profits second. I also want to emphasize that legitimate penny stock opportunities do exist. There are real companies with real businesses trading under $5 that can generate extraordinary returns, but they're rare. maybe 1 in 50 or 1 in 100 stocks you evaluate. That's why you need this checklist to filter through all the garbage to find those rare gems. Most investors do the opposite. They chase every exciting story without doing any due diligence, and they lose money on 49 bad investments hoping to hit that one winner. Don't be that investor. Be patient, be disciplined, and only invest when a stock passes your complete checklist. Now I want to hear from you. Drop a comment below and tell me which of these 8 checkpoints you found most valuable, or share your own penny stock disaster story if you have one, because those stories help other viewers learn and avoid the same mistakes. If you found this checklist valuable, please smash that like button because it helps the algorithm show this content to more investors who need this information to protect their money. And if you haven't subscribed yet, hit that subscribe button and turn on all notifications because I release videos every single week where I analyze real stocks, show you how to do proper research, and help you avoid the landmines that destroy most retail investors. In my next video, I'm actually going to take real penny stocks and run them through this exact checklist so you can see specific examples of stocks that pass versus stocks that fail, and that will give you even more practical knowledge for your own research. Thanks for watching. Stay disciplined with your research, and I'll see you in the next video where we continue building your investing knowledge and protecting your hard-earned money.